time can heal all your woes.
All right, guys, welcome back. It is Wednesday, live with Josh Lewis, Buywise Mortgage, here to answer your real estate questions. The intro there, the music, it came from a viewer, Mark Stewart. I don't know the band name. He sent me a couple tracks last week. I said, if you have music, send it to me. So what I've decided I'm going to do is, if you're an artist out there, you have copyright-free music, you want to send me something to put out there, I'm happy to promote it. So put it out there. If I knew the band name, I would tell you. If you liked it, he's welcome to comment in the chat as well, and give you his take and send you to his page to download if you want more. So Josh, what's happening, my friend?
It needs to be family friendly for all you aspiring rappers out there. No explicit lyrics. This is a family friendly show.
We'll listen to it off the air if it's not. But yeah, thanks for joining, guys. I already have some questions coming in. If anyone saw my live yesterday with Kyle, this is going to be nothing like that one. This one's going to stream smoothly. We are not running internet off of prepaid cellular phones over here, Kyle. We have broadband, my friend, so it's going to go a little bit smoother, we hope. But thank you guys for joining us. We got Jennifer Lego here, one of our moderators, helping us moderate the chat. So if Jennifer says something to you, listen to her, please.
Hey, Jeb, I did hear that once the Cleveland broadband build out is complete, they're going to move on to Dayton. So Kyle may at some point in the future actually be able to connect and do this stuff from his home.
Yeah, he's trying to get out of there. It sounds like it sounds like he's not a big fan of the place. But anyway, let's move along here. We've got some questions. Actually, Jennifer showed up early and had a question in the chat here that we're going to start with. So her question is, can our real estate agent help us figure out the right property tax and insurance rate on a specific home? The listing apps are inaccurate. That would determine my budget more than interest rate. So Jennifer, here in the state of California, actually in Orange County where we are, you can look up the tax rate. You can go to the assessor's website. You can type in a parcel number or an address. It'll show you what the tax rate is, plus any additional bonds or anything on that more or less gives you the effective tax rate. Where you are, you're in Indiana, I believe. I don't know if you have access to that. There should be something public record, I would think, where you'd be able to grab that. And then insurance rates on a home are going to vary a little bit just depending on the age of the property and that sort of thing. But I know lenders use a specific amount to kind of determine as an estimate when they're doing calculations. So Josh, what are your thoughts on both those questions?
On the insurance stuff, we used to always use 0.35% back in the 90s. That was sort of our rule of thumb. Now the problem is home values are so high and so expensive, largely due to land values, that it gives you an exorbitant number. So we use 0.25 and usually tone that down even. So it's hard. It's hard for a first-time buyer, and it varies so much in regions of the country. Like if I'm saying 0.35, oh, that was excessive, and you're in Texas or Florida, you're going, hey, are you nuts? I would love to pay 0.35%, because anywhere where you have tornadoes, wind issues, hurricanes, that type of stuff, it's going to be so much more expensive. So We don't need two Californians telling you guys about our relatively low insurance rates, unless you unfortunately happen to be in a fire hazard area, which we have more and more of, in which case you can also pay hurricane level insurance rates. So it's something that we on the professional side are really careful with. We want to ask the client. So for us, what's most likely to have a high insurance rate? Here in Southern California, we're saying, are you buying in a fire hazard area? Are you up in the hills? Are you in a brush area? And that tells us we may have a higher amount of homeowners insurance. And then on the same token, for us in California, it's special assessments or Mello-Roos. You don't need to know what Mello-Roos taxes are, other than it was a way of the government pushing the cost of infrastructure onto builders and then onto homeowners. So it's just something we need to be aware of. New construction can have a much higher tax rate than older construction. And Jennifer, the biggest thing I would say is if the big beasts in the mortgage industry with their awesome websites aren't getting good and accurate data, it's probably going to be pretty hard for you to get good and accurate data. Different states make that data available to different levels at different costs and difficulty in acquiring it. But if Redfin and Zillow aren't acquiring good data, it probably doesn't exist in a way that a consumer can grab it.
All right. Thanks, GD for coming in. Again, Jennifer's here. Joey thought he was going to be the first, but he was not. Move on.
There's always next week. You can try hard.
Yeah, you can try to log on at 4:18 instead of 19. Let's see what we got here. So Michael Dury, I believe Michael is in Texas. Looks like he already has some equity. He's buying new construction, I believe. Yeah, not even building yet and already on to the next phase. So congrats there. Got Blake saying hello. Here we go. DJ Romano. So DJ Romano, his question is good time to refinance and remove the PMI. So did a video earlier today talking about refinancing, just because I'm getting a lot of questions from it, just because rates have come back down, mortgage applications are up, and 60% of those applications are actually refinance applications because people felt like they missed an opportunity and now jumping back in it. I'll let Josh jump on this, but if it makes sense, yes. The answer is yes. If it makes sense. I mean, why, what would be the reason for waiting? But Josh, go for it.
So, yeah, let's hear. And just, this is going to be a common question tonight, because here Freddie has basically the same question. Purchased last year, home's gone up in value. Should I refinance? With that increase in value, probably looking to get rid of mortgage insurance. So a similar question. And it always falls back to, again, the numbers never lie. We want to put a side-by-side comparison of what does the current loan look like, what does the new loan option look like. What I will tell everyone, a month ago, everyone was saying rates are up, and they're going up, and we're going to be almost 4% by the end of the year. You can go back and watch our recordings. We told you that's not going to happen. We're still in a 40-year bull market for interest rates. Rates are still in a downtrend. What that does not mean is that month over month over month, rates are always going to be lower, even in a 40-year downtrend. We've had months and years where rates have trended up. So we started to see a little bit of that in February, where rates pumped up about 0.5%, and we've got about half of that back. So the bad news is we're not at the absolute lows of December and January. The awesome news is we're getting a bunch of these crazy sales closing with much higher values. So if you have the opportunity to get a similar or lower rate and get rid of your mortgage insurance at a low or no cost loan, it makes all the sense in the world. If any of you guys out there still use Quora, it's a website where you could go and ask questions, and experts would chime in and put their 2 cents in. And someone had asked me to answer a question saying, what VA lenders in the country are doing no and low cost loans? And there was actually a national expert that is a syndicated columnist that writes every week, and she pipes in and says, there's no such thing as a low or no cost loan. Say, okay. If we want to talk what the truth of the matter is, there's no free lunch. So if you want a low or a no-cost loan, it's not that there is a lender or a vendor out there that says, hey, we don't want to get paid for our loans. The truth of the matter is that lenders will pay a premium for a slightly higher interest rate. Well, different lenders do charge vastly different amounts for closing costs. Now, do not take this, if you're outside of California, as something that could be done for you. In California, we have a lot of escrow and title companies to choose from. We do a lot of volume. We've done a lot of shopping. If you come to us for a refinance, unless it's a really large loan, if we don't need an appraisal, it's going to cost about $1,500. If you do need an appraisal, it's $2,000, $2,100, right there in that range. So for most people, a $300,000 loan we need a 0.5 point lender credit to cover all of your costs and not add anything into that loan. So a 0.5 point from the lender usually requires an increase of 1/8%. So you have to decide, do I want to chase after the absolute lowest rate and payment, or do I want to do this at nearly no cost, realizing that for 40 years, whether it takes 1, 3, 5 years, we've had a refinance opportunity coming behind it where you can get that new lower rate for free. So going back to what Jeb's answer was, is run the numbers. If the numbers make sense and we can save money today, do it low or no cost and be ready to do it again in a year or 3 years or 5 years when the opportunity presents itself.
All right, there you go. Jose has a really easy question, so I'm just going to get this one out there. In-N-Out or Tommy's?
Both.
Easy. Yeah. I like the both answer, but I'll go In-N-Out. Simple's good. I like simple.
Tommy's is sort of like dessert. Like dessert is awesome, but you don't want it for every meal. So like In-N-Out, you could eat nearly every day. Tommy's you got to save for special occasions when you're really going big. Like 3 a.m. return home from places that you don't know why you were there or how you got there. You make a stop at Tommy's on the way back.
There you go. Fantastic. Laniamel has a question. What credit score should we strive for the best possible rates, Josh?
So it's going to vary by loan type. So let's start with the easy one. Fannie Mae, Freddie Mac loans, their loan level price adjustment matrix stops at 740. So anything above 740 is going to be the same. So if your buddy has 741 and you got an 820, you get no advantage over them. So 740 is your hard and fast line there. Government loans, FHA and VA, are a little bit different because they can vary from lender to lender. But for the most part, you need a 640 to get a good rate. You need a 680 to get the best rates. There are lenders that will give incentives because they want to bring up their average, their weighted average of their credit scores in the pools of loans that they're selling. So they'll give incentives for a 720 or a 740. But for the most part, your government loans get above 680, you're going to get the best terms. Conventional loans above 740. If you're in the market for a jumbo loan, it can improve all the way up to an 800 credit score. I really never seen anyone given any benefit for anything up above 800. Your 800 is generally your highest tier. So if we're trying to get the absolute best rates, 680, 740, and 800.
All right. D Boy Trucker 80 has a similar question as the one that you answered a moment ago, but a little bit different. So just purchased a home in Riverside on a conventional loan. When and how can I get rid of PMI? So I'm assuming you put less than 20% down. For those of you watching, put less than 20% down on a conventional loan. You will have mortgage insurance most of the time, unless you did a first and second. So probably has mortgage insurance there. You need to get it down to 80% to get rid of that mortgage insurance. But Josh, what's the easy answer there?
So if you're looking at refinancings to get rid of it, you're going to have to wait at least 6 months. We can't use the new appraised value. As fast as properties are appreciating, we have to have that loan for at least 180 days before we can use a new appraised value. If you're looking at just petitioning your current lender and seeing if you can get rid of your mortgage insurance, you're generally looking at having to have it for 2 years, and then you're going to contact them, go through the process, they have you fill out an application, have you pay for an appraisal to confirm that they have their 80% equity position, 80% loan to value. So one thing to point out is some people feel like, well, I'm not going to do it until I can completely get rid of my mortgage insurance. With rates as low as they are, ran a quote for a viewer of the show today, and 2 borrowers, high 700 credit scores, and even with 10% down, we were looking at a 0.15 mortgage insurance rate. So if you bought with 3 or 5% down and you're paying 0.5% or 0.75% for your mortgage insurance, it can make sense even if you haven't got all the way to 80%, but you're going to wait at least 6 months before you can use that appraised value.
All right, good stuff. Got a super chat here from GD, $5. Thanks, GD, for doing that. That buys Josh a NATO 5.5. He loves half beers, so that'll be perfect for him.
We don't have any halves here with us today, though.
Well, that one's going to be half here shortly. Hello, guys. Home. I am looking to buy a home that doesn't have a cooling system. Home is 5 bedroom, 3 bath, 25 square feet. What are my options to have a cooling system? So a lot of homes here in Southern California, not sure where you're located, don't have air conditioning. Believe it or not, Huntington Beach was considered an area when it was built in the 60s that, climate-wise didn't need air conditioning because you live by the beach and you got a breeze and whatever. That's garbage now. There's about 3 months out of the year where you need air conditioning, no doubt. So I see a lot of homes with no air conditioning. So it depends on, what your kind of system you're trying to put in. I mean, I see a lot of homes that where the furnace and the condenser, the furnace needs to be replaced. You have to add a condenser, you have to do new ducting and all that good stuff. Typically runs $12,000-$13,000 depending on the type of system here in Southern California. Now, when you start getting into dual systems, and because you have an upstairs and a downstairs and a larger 2,300 square foot house, you might need dual systems. I mean, you're probably talking somewhere in the 20s there to get something like that done. Outside of that, I don't really have a lot of recommendations for you. I mean, it's most of the homes here, unless they have wall heaters, have some sort of venting already in place. So adding the ducting, replacing the furnace and HVAC is not really that difficult of a task. But anything you want to add on that, Josh?
No, it's a pretty good sized house. The things that are popular in areas where maybe it's not so hot that you have to have the whole house air is you have the room air conditioners. But Jeb, when you looked at adding it to your house, it was going to be more expensive for two of those than for a nice whole house system, wasn't it?
Yeah, no, for sure. Yeah, I was going to think about doing the individual units, but those things run $3-4 grand a pop, just for each room. And then they still have to vent to the outside. So you have to have like small little condensers that run to those. And, quite frankly, not as pretty as a nicer slim unit on the exterior, in my opinion. Your other option would be something like a whole house fan, depending on where you live and the climate. Those things do work. They're not going to provide cool air, but they will suck the hot air out of the house, which could help on those hotter days.
The last option there that is probably the best choice is big ass fans. So go to bigassfans.com. It's an awesome company, and they actually now have, generally just started out for industrial businesses. Yeah. Now they have home versions, but they're giant ceiling fans that move very slowly, but will move a lot of air and get the hot air up and out of your house as well.
Yeah, blow you right out of the house. You won't even be able to sit in there.
No, they're slow moving, no blowing. They're very slow moving.
No, too funny. All right. So Nicole Jansen. So hopefully that helped you out, GD rather, not JD, GD. But thank you again for the super chat and the super sticker. Nicole came through with the dancing pear avocado. What is that thing? An avocado, perhaps. But anyway, thank you for that as well, Josh. That gets you another 805.5. So you're up to 3. That is right where you need to be by the end of the show. 3 would be good times. If we end the show in half an hour, that'd be good for you.
Yes,
2 hours is not going to run enough. Let's get down where we left off here. And guys, got some questions coming in. Just stay patient with us as always. Hit that like button if you found this stuff valuable.
You'll like this one, Jeb.
Well, there you go.
You're the expert on these.
Mm-hmm. When using escalation clause, is the buyer allowed to see the other offers that made the buyer's bid go up? It depends. It depends on how it was written. When I write an escalation clause, part of that escalation clause is, buyer willing to pay $1,000 higher than the highest offer up to whatever price we decide, with proof of the highest offer, right? So, hey, I've laid it out there. We're willing to do this if you're willing to show me the highest offer. And with that said, I'm not looking for personal information. I don't need the buyer's names per se. I don't need all their documents, but show me that there was a legit offer. And a lot of times I'll ask, hey, look, can you share the agent's information with me? I'm not going to call them, but I just need to know that there's somebody on the other side of this and it's not you typing up offers and what have you. So yeah, could somebody finagle that if they really wanted to? Of course they could, but in an environment like right now where things are, flying pretty quickly, offers are coming in, I don't think it's that big of a concern to think that somebody would offer, a price a little bit above where you were actually willing to go because of how many people are looking to purchase at the same time. So, maybe be weary if something doesn't seem right, but yes, you should be able to see at least that offer, not every other offer on top of that, just FYI.
And Jeb, most of the escalation clauses I see you send over, you copy us whenever we submit an offer for a client. So I see a bunch of them. It does have a max number in there. It's not, hey, we're going to pay $10,000 over the highest price up to any crazy number. You're putting a limit in there, right?
Yeah, I am. But I have seen. We had accepted one earlier this year that the guy put no. He was willing to pay 10,000 higher than the highest offer with no limit. And I went back to, and we actually he ended up with the property because he was 10,000 higher than the offer. And that the reason he was willing to do that, because I had a conversation with the agent after. I was like, that's nuts. And she goes, that was the first time I'd had that as well. She goes, but understand, he's from the Bay Area. He's used to, you know, offers going $100,000-$200,000 above the asking price sometimes. And, he was willing to go because he knew that in this market, we weren't having that same type of thing here. So he didn't think it would go that high. So he was willing to put his cards all on the table. So, in that case, it won him the offer. So, hopefully that answers your question there.
How did it work out for him? Because we're going to have a couple of other questions here, but let's just lead into it. Yep. Here we go. Single family houses selling 15% over asking right now. Comps are thin because supply is low. How are appraisers handling that? So in that situation, did the appraisal come in for that buyer?
It did.
Okay.
Yeah, appraisal came in. Appraisal came in. I was there to meet the actually, hold on. Appraisal on that one. Let me think. There was the appraiser called me to have a conversation about that property. So no actual appraisal in hand. The appraiser, they must have had something, through some sort of automated deal where, the appraiser just called to ask me some questions about the property, some of the upgrades that were done. Never actually came out to the property on that one. So appraisal was not an issue, but part of our counteroffer was that they waived it because of where the prices were going, and they were willing to do it. But to answer Lion Roar Gamer's question, how appraisers are handling this, in a couple of different ways, right? So they obviously have to take the comparables that are out there. And Josh can tell you the story. We've told this story a couple of times. If there's something unique about the property, it backs to a freeway, it backs to, a river or a freeway, or I said freeway, or something really unique about it, they have to go find specific comps in a lot of cases that, even if it's outside of their 90 day window or typically 6 months, wherever they're trying to stay, if at all possible, that they sometimes they have to use those old comparables and make market adjustments based on what's happening in the market, so on and so forth. So, appraisers are a lot, and I've been fortunate where all of my appraisals, in fact, have come in at value. I know you've had a couple that have not, Josh, but what else are they doing? Me as a listing agent, I'm showing up with the comparables of other properties. They're calling agents that have properties in escrow in those areas to find out, hey, where did your property go into escrow? If you're willing to tell me, how many offers did you have? And they're using all of this. Now, when, if you've seen an appraisal, if you've ever seen an appraisal, typically, this isn't, in stone, they try to find 3 or so properties that have sold, 3 or so properties that are maybe actively listed to show, values or what have you. But there's also an area where they can make comments on the market, on what's happening. And they use that area to help justify why they're making the assessment or the estimate that they are in the appraisal. And because of where things are going and the demand, we're not really seeing any issues. But Josh, anything you want to add to that? Because I know you see more appraisals than I do.
So I almost want to reiterate a conversation that I had. We have a client out in the Castaic area, and they were referred to us by a past client. So it's a realtor that we don't know. Realtor's been great, but the realtor told them, hey, we need to go in non-contingent on the appraisal, and it scared them. So they called me and said, what does it actually mean if I go non-contingent on my appraisal? I said, well, first of all, have you seen comps in the area? So we've seen a bunch of comps. There's one a little bit higher, but it's maybe upgraded, nicer. There's a bunch of them in the same or just below it. So what I did is I gave them, here's what's happened for us. I've had one come in $4,000 low. I've had one come in $5,000 low. And those are infuriating because to me, Appraising
Yeah.
is not a science. There's no appraiser that can tell me they know that it's worth $5,000 less than what we paid for it. If you tell me it's worth 20, and there's probably enough of a discrepancy there that we should have a discussion. $4,000 or $5,000, no person can tell me that they know to that degree. But 4,000 and 5,000, and we worked through those. Had one that came in 12,000. Buyer just made up the difference. The $40,000 one was the one Jeb was referencing. Very unique. It backed to a freeway. So what I told them, these buyers have some additional money. They don't have 40,000 additional dollars, but if it came in $5, $10, $15,000 short, they can and would make up the difference. So telling them that as long as we're comfortable that the comps are there, going in with without the appraisal contingency is not that risky as long as we know it. Now, on the flip side, I had another client and I told them this. I don't even know the area. It's in LA County, but it was way out in this canyon, and it was a odd, unique property. They loved it because it was odd. I looked at it and said, that's an odd house. I don't think I'd want to live there. But a unique property in an area that did not have a bunch of comps and nothing within $100,000. The listing agent called me and said, hey, what are you guys going to do if this appraisal comes in? I think the appraisal's coming in at 720 and the offer is 820. I said, well, let me look at the comps. I look at it and go, you are right. We are not getting an appraisal anywhere near that. So it's very important that you look and say, am I at least comfortable that there's comps that get us in the ballpark? Because the part that Jeb answered here is, what are appraisers doing? Appraisers are doing their best, and they're doing a really good job of getting us something close to what the market is saying the property is for. But if you have a unique or odd property that's difficult to comp, and we may not have a comp that has closed in the last 6 months when the market really accelerated, you could have a problem. So you just need to know how likely are we to come in? How much are we likely to be short if we're short, and am I comfortable with that?
Yeah, no, and I lied. I did have an appraisal come in less. One that Billy had. It was here in Huntington Beach, in fact, and it was a $515,000 purchase price, and the appraisal came in at $508,750. So it was what, $6,500 less on the appraisal, and the agent wanted to 508,750. No, that's not right. The math's not right there. 7,500 less, and 6,500, 507.
It was less than 7,500.
Yeah,
it was
there we
close
go.
enough. Yeah.
Anyway, so we renegotiated. The agent on the other side wanted the client to make up the difference. I said, we're not making up the difference, and we don't have the money to make up the difference, so on and so forth. They ended up lowering it to the appraised value, so the client got it at the appraised value. So we have had one, but it worked out for the client. And we didn't waive the appraisal contingency on that one, FYI.
The thing that I would say on that is it's important that everyone be cool. In life,
1,000%.
that's a good rule. Be cool. That was a very good listing agent. She was cool. Jeb and Billy were obviously cool on our side. Our buyer was awesome. She had already bent over backwards and done a ton of things to make it work, and we just didn't have it. I mean, if she had another $2,000 or $3,000 or $4,000, she would have kicked it in. But she was already stretched as far as she could go. Everyone talked it through and just said, hey, this is where we're at. This is our best bet. And even for the appraiser, that one is just outside of that $5,000 range. But I looked at it, Jeb and I looked at it, like, I don't know how you could appraise it for more. The market is saying it's worth more, but I don't know how an appraiser has enough data to say it's worth more.
No, absolutely. Got a good question here. Josh, let's see here. James says, finally under contract, and the sellers are asking for a rent back. So congrats on getting into escrow. James, what happens if there is a home insurance claim during that period? So you're going to have a seller in possession type form of some, depending on where you're located. In California, it's called a SIP, seller in possession form, which essentially is a rental agreement, if you will, for the buyers or for the sellers of that property to stay in that property for up to a period of time. Lenders won't allow you to do a rent back if it's a primary residence for more than 60 days. So it has to be 60 or less, Josh.
60 or less. Your occupancy affidavit with your loan document says you're going to move into the home within 60 days.
Right. So in the case that, new buyer, his insurance is going to kick in when he closes on that property. So if there's an insurance claim during that time, that your homeowner's insurance policy is going to be in effect, because that renter quote unquote renter, the tenant isn't going to have renter's insurance for that period of time that they're in there in most cases. So it would fall back on you as the homeowner. But I fortunately, knock on wood, never seen or heard that happening. I think that's the right answer, Josh.
No, it's exactly the answer I'd give you. I mean, because that seller, once they've sold you the property, they're not going to keep insuring the property. You're insuring the property. And again, tenant's insurance, renter's insurance is going to cover their contents. It's not really covering your property. Maybe it would cover intentional damage, but doubtful on an insurance claim. So that's probably what you're looking at. Jeb, we jumped over one here. We got the wonderful super sticker from Nicole Jansen's, and then she came back with her question.
There we go. Thank you. So thinking about a full fixer-upper, I'll renovate after closing to be competitive. If I go for a short-term rental loan after purchasing, can I change jobs, accrue any new liabilities during construction? Josh, why don't you take that?
It comes down to the overall qualifications. People always ask, can I bring on new liabilities? Well, it depends. I was talking to a client today that we have them stretched out to the absolute max. They're making more money now, but the underwriting qualifying income with the 2-year average of their self-employment is lower. So we've got them at 49.99% debt to income ratio. For them, if they did anything, they're cooked. There's no additional debt allowed. Now, that same borrower, if we were using their current income, if it was a salaried job, they would be at a 30% debt to income ratio, and we'd have plenty of room. They could go buy a $1,000 a month auto. They could do, any number of things without it ruining the qualifications. So we just need to know what are the qualifications for the new loan, the new takeout loan. And we're making some assumptions that rates stay level or similar to where they are right now.
Right.
Income stays similar, and then debt level stays similar. And if not, how much wiggle room do we have there before we hit a ceiling on the debt to income? So hard to answer. There's no hard and fast rule that says you can't take on debt. That doesn't disqualify you. An excessive debt to income ratio disqualifies you. So that would be the piece you would want to look at. And then changing jobs. People are always under the impression like, oh, I can't change jobs. Changing jobs is not a problem. Large gaps of employment and or changing to different industries, or more importantly, things like, hey, I have a wonderful W-2 job today and tomorrow I'm self-employed. Those things can be problematic. I talked to a borrower today. I'm going to forget, it was her husband. I believe he's a truck driver. He's switching from a company that's $22 an hour to one that's $26 an hour. And he's going to stop one on Friday and start the next one on Monday. No one cares. No problem. We have no gap of employment. He's staying in the same line of work, and it's an upward movement. So changing jobs won't be an issue. Having a change in industry, having a change in pay could be a problem.
Yeah, there you go. Good job. All right, good stuff. Let's see what we got.
Did you get your t-shirts made yet, Jeb? Do we have our good stuff t-shirts?
No. I need some. If anybody's a graphic artist out there,
we need graphic artists. So if there's any
somebody that's good.
A good graphic artist, not someone that plays on their iPad with their Apple Pencil and makes some kind of cool stuff. We need some really cool stuff.
There you go. Tried getting a duplex for the past 2 months. All I've seen is embarrassing. Should I wait for more inventory to get a decent duplex? So sounds like you haven't seen a decent duplex based on the embarrassing comment, but it depends. I mean, that's the one thing I've told, in the videos where I've talked about potentially more inventory coming. I think that there's an opportunity, not that the market's going to slow down with more inventory, in my opinion, because I don't think it's going to be enough to slow the market, but I think it just gives buyers more options, right? So depending on where you're located and what you're trying to purchase, perhaps more inventory gives you a better opportunity to buy something more like you want. But maybe buying a duplex that is quote unquote embarrassing allows you to get it for less money and allows you to put your stamp on it to get the value up to maybe where some of the others would be selling if they had already done that coming on the market. So I would take it, kind of look at it from both perspectives. And figure out what it is you're trying to accomplish with the duplex. Here in Southern California, if you can find a duplex at a decent price, you should buy it. There's just none. There aren't any. And the ones that come on the market it's just incredible where prices have gone on some of these, and it's hard to get them to cash flow. And that's another thing is, why are you buying the duplex? Is it for cash flow purposes, or is it to live in one and rent the other? And I think there's some questions in there that probably need to be addressed in a little bit more detail to give you some,
some of it also
solid answer.
Some of it also comes down to how much work are you willing to do. When I say that, we're in a very hot market with limited supply. If you're further limiting what inventory you would be interested in this case, a duplex, and I'm probably also assuming here you have a fairly narrow target of where you want to live and where you want that duplex, there are far less duplexes than single families. What I would say is there are a lot of sellers out there that have no idea what their homes are worth right now. And they could be enticed by an offer from someone who doesn't have representation. So we've talked about this, not the best thing in the world to go in without an agent, but if I were looking for, if I had a very specific neighborhood, there's a neighborhood here in Huntington Beach that I would love to be in. There's only 50, 75 houses. They don't come on the market real often. As much as I love Jeb, and Jeb's awesome, if I wanted one of those, I can wait for one to come on the market, or I could start knocking doors. I can pull a title profile and say, who's been there the longest? Are there any absentee owners? So with a duplex, someone out of the area, especially if they're out of state, may not be familiar with what the value is and what they could monetize from that. So sometimes you have to get creative and do more work than you otherwise would be willing or able to do. It'd be nice to just call up your realtor and say, hey, I want a duplex in this 4 square block area. Please find me one. When they don't exist, sometimes you got to just dig in and do the work yourself.
Yeah, and if you're not willing to do that, some agents are willing to do it. So find an agent that is willing to do it. But the last thing I'll say on that is don't settle, right? If you're buying the decent duplex and you're settling because you can't find one like you want, I would say not. I mean, wait, right? Wait for more inventory. But if you're okay with the one you're buying or potentially buying, then there might be some trade-off there in versus waiting, because of where things are going with regards to appreciation. Rose has a question here. What special considerations should I take for houses with unpermitted additions? So we see a lot of that here in Southern California. Things that, back patios that were converted to, porches or, me being from the East Coast, originally from North Carolina, you see a lot of screened in porches. Here in Southern California, they're not screened in. They're actually, they have windows and that sort of thing. And a lot of them are unpermitted. Depends on where you're located. Most of the time, if they're done in a workman-like quality, with some craftsmanship by somebody that actually knew what they were doing, I would tell you there's probably not a lot to be worried about. But to each his own, right? I mean, that's not going to be, everybody's not going to be comfortable with that. And it really just depends on what it is that you're buying. That typically is not factored into the value of the home. Unpermitted additions aren't factored into the value of the home, and or they shouldn't be when an appraiser is appraising the property. If it's not part of the actual square footage, it shouldn't be used to calculate that value. But you see a lot of agents out there using those to help justify the higher prices and the additional square footage. So just be careful with that sort of thing. Anything you want to throw on that, Josh, with unpermitted?
A lot of this falls back to use your common sense and your better judgment. I've bought and sold a lot of homes, a lot of older homes. And the thing that you'll realize is building permits before, say, like the late 70s, early 80s were kind of janky and a joke. So if you buy a 1950s home and you have everything permitted, it doesn't mean the same thing as if everything was permitted in the 90s when they did a big addition. So what has always happened with that? The appraiser goes through and they look and they say, does everything look right? Jeb's preached incessantly here about making sure you have a home inspection. The home inspector is going to go through and say, hey, I don't see evidence of any permits for this, but looks like it was done to code and was done accurately, properly, I should say, and you could get it permitted if you want to. So Jeb hit the valuation issues and trying to make sure you're not overpaying for square footage that isn't legit legal square footage per the assessor's office, but a lot of times it sure as heck could be. I've seen some really beautiful additions that were not permitted that I would have no problem buying. I've also seen some really janky ones, and you'd be like, no, we don't want any part of this. And for the houses we flipped, a lot of times we had to pull those off. A seller's trying to say, hey, it's this much square footage. I'm like, well, cool story. I got to rip that thing off the back of the house. You're costing me money. You're not adding value to the home.
No, so hopefully, and it depends on where you are, right? I mean, some areas might be a little bit more strict on that. Some areas, if I've heard of, unpermitted things, the county finding out about those and trying to make an issue. So just, make sure you do your due diligence if you're thinking about something like that, or talk to somebody that has some expertise in dealing with those. Owning owning does pretty well if LTV is less than 73% in Cali.
So owning the lender is who he's talking about. And
Gotcha. I'm like, okay, who are we talking about
yeah,
here?
no, and just be aware of what owning is. Owning runs a ton of
call center,
billboards. It's a call center, so you're going to be dealing with a kid in the call center. Anything right or left of center, they have no idea what they're doing with. Their primary objective is, we talked earlier about like there's no benefit above a 740 credit score. When a lender goes to sell their pools of loans, the higher the weighted average credit score is and the lower the weighted average loan to value is, the better their pricing is going to be. So don't get me wrong. I've had clients call me, say, hey, owning's willing to do this. And I'm like, it doesn't make any sense. I go, well, tell me more about it. Say it's a 50% loan to value. I have an 800 credit score and I've been on my W-2 job for the last 50 years and I have no debt. Well, cool. A kid in the call center can't screw that up and they're willing to overpay for that loan. So it just comes back down to, we get this question all the time. We had a viewer send Jeb an email saying, hey, can you connect me with your lender? I want a second opinion here. I want to make sure I'm getting the lowest rate. And I want to be 100% clear here that the lowest rate is not the most important thing. We've talked about this. You absolutely want a competitive rate and you want low fees. You don't want to overpay for anything. But for the most part, the lenders that are offering discounts are not good lenders. They're not experts. They're not someone that's going to go the extra mile. They're not someone that's going to be available for you. You know, if you go look at one of our Google reviews, we just got a Google review from James Choi. He's popped up here several times. He came through the show and he was actually, it wasn't owning. He was with better.com. So again, better. By definition, if you go to their website, they'll tell you, we're better. We do this, we do that, there. They're salaried kids sitting in a call center. They have no idea what to do. They weren't available to him on nights. They weren't available to him on weekends. They couldn't talk to his realtor. They certainly couldn't talk to the lender or the realtor on the other side to help him get an offer accepted when he was getting beat out on offer after offer after offer. So even if they were an eighth lower in rate and $1,000 lower in fees, are they better than using a professional lender? No, they're not, because you're never going to get a house.
There you go. Said from Josh Lewis. Anyhow, is a clear to close from the underwriter a positive sign the home is now guaranteed before closing date? Josh, so Pogimoto, regular viewer on here. Thanks for joining us and the support.
Is Pogimoto our viewer that rides down the 405 on that motorcycle watching us, or is that someone else?
No, I think that's someone else. I think maybe. I don't remember. I think it's someone else that comes local.
I'm stereotyping all motorcycle riders and just saying they're all the same. They all look the same.
Yeah. Exactly.
So, it's not a guarantee. Nothing's a guarantee until the wire shows up at escrow. And truly,
no, that's not even a guarantee. That thing
not even a guarantee. It needs to record. Until you get the notification that the loan has recorded, you're truly not in the clear. Now, have I personally ever seen or heard of a clear to close loan not closing? No, I haven't. But I would guarantee
knock on wood for you.
I would guarantee you it has happened. Things can come up. What clear to close means is that the file was underwritten. They went through and said, these are all of the conditions that we have to meet, and they've all been met. It doesn't mean that they're not doing undisclosed debt monitoring. So here's an example. Extreme example, Pogimoto is way too smart to do this. But let's say that Pogimoto runs out, he hears that he's clear to close, and he goes and buys a new Maybach for $200,000 and leases that thing at $3,500 a month, blows his DTI out. They're going to see it on the undisclosed debt monitoring and say, why did Mercedes-Benz Finance do an inquiry? And he's going to have to say, well, I bought a sweet new Maybach. And they're cool. Show us the payment on that. Well, here's my lease statement. It's $3,500 a month. Now your deal's dead. That's probably an extreme example of what you could do to blow up a loan after clear to close, but other things can happen. That being said, you are as close to a guarantee as you're going to have at any point in the process. All of the conditions that the underwriter had have been provided and cleared and accepted.
God, you couldn't pick a better car than a Maybach? People even buy those things anymore? They still out there?
They don't even have their own brand. Now it's a Mercedes Maybach. So it's like, it's still there, but it's like an S-Class, but like it's an S-Class on steroids.
There you go. You just compared it to an S-Class. That's fantastic.
It's an S-Class on steroids, bro. It has curtains and like footrests and all sorts of stuff.
All right. Got a super chat from Joey Crack. Joey was here early, but then Joey just disappeared. Joey disappeared on us. Didn't want anything to do with us, but now he's back and he gave $10, which buys, almost a 12-pack of 805s for Josh. He's happy. Would it be shrewd if you should you be accounting for them? Put the money you earmark as closing cost as earnest money to make your offer more attractive.
So
No, I don't think
up
that's
your earnest money.
yeah, I don't
So
think
just
that's
to
shrewd at
clarify for
all.
everyone, what he's saying is, if I have $10,000, $15,000, I know I'm going to pay for closing costs. Should I make that much of a larger deposit and put it into escrow at the beginning of the transaction for the seller's benefit?
There's a yes and no to this. One is, in the state of California, for example, when you sign the arbitration mediation clause as part of the residential purchase agreement, now that's one of those things that you can opt to sign or not to sign, but it's cheaper, less expensive. Typically, if something were to happen, to go through that mediation and what have you. So most people sign it to agree on that because it ends up saving you money in the long run. That, when you sign that, essentially the seller can't take any more than, say, 3% of your deposit based on the way it's written. Now, if there were other things going on, that can change, but 3% based on deposit. So if you offered more, essentially you're putting more money out there. It's not, I typically don't recommend you put more than 3%, but there's some other ways that you could make it, attractive. I mean, you could offer more for sure. And that might stand out. But you could at some point in the contract, based on how it's written, you could make part of your deposit non-refundable. Now, once you release, get to a certain contingency period, you could make part of your deposit non-refundable at that point, to make your offer appear more attractive. Now there's, I don't know in this market if people are looking, at that deposit, knowing that there's only a certain percentage that they can take out of it and using, I don't know. I don't know if it actually appear more than
it would come down. It would come down to their agent's ability to know that. And I hate to hammer on this.
That's fair. Yeah.
I hate to hammer on this, but we've talked about it before. 80% of realtors and 80% of loan officers are worthless, and they would have no idea. They would go, I like this one. It's the same price, but it has a bigger deposit. So a lot of it just comes down to the knowledge and expertise of the listing agent.
No, that's fair. Yeah. But I mean, I think in some cases it could help you stand out. No doubt. So hopefully that answered your question, Joey. If it didn't, sorry, man. I appreciate you being here. All right. And thank you for the super chat.
I still don't like the gloves, $10 or not.
Dude, he's trying to give us enough money to buy. Maybe we'll buy you a set of gloves to put on your thing. Maybe that'll be your little chat head.
Could we get them that it was like this and it would say 805 there? So for holding, keeping your hands warm.
You probably get somebody to make it. Maybe our graphic artist can make that.
I like that.
Okay, let's see who we got here.
Here's one, Jeb, that's not a question, but a comment. I've been outbid by $115,000 in LA County. We had a buyer that came off of our website this week. He got super excited. He found a house. It was the first offer he had made. And Russell, my loan partner, had told him, okay, well, be prepared. Everything's going well over asking price. So we called back 2 days after he'd made his offer. Hey, how'd it go? And he just starts laughing. He goes, well, you guys warned me, but it was a $630 list price. They had offered $650. The home ended up selling at $750. So unfortunately, we're hearing more and more of this craziness, and it's not unique. I keep getting clients here. So we only do loans in California, and I'll have someone say, hey, I'm in Sacramento and the market's really hot here. Or, hey, I'm in Riverside and the market's really hot here. And I say, hey, good news is you don't have to feel unique or bad about your situation. It doesn't matter where you are in the United States of America. We make fun of like areas like Nebraska and Kansas not being super hot and viable. I'll bet you those people are in bidding wars, and they're talking about that house went $5,000 over list price over there.
No, there's some truth to that. It's all relative, right? I mean, it definitely comes down to median price. And here in California, did a video on a couple days. We're up to 758,000, I think, in Southern California. We're up 8.5% month over month. So from February to March, prices have increased on the median. The median home price has increased 8.5% in 1 month. Crazy. Anyway, Jonathan's got a question here. Good question. Is there a penalty if you pay more than your required monthly mortgage payment? The answer is no. No. So, go ahead, Josh.
Look at it. So post 2008, new guidelines passed. basically any traditional loan, Fannie, Freddie, FHA, VA, USDA, none of those are going to have prepayment penalties. You can have a prepayment penalty with a non-QM loan, a portfolio loan. Even with those, they're very rarely imposed because it makes them non-QM, and it's more of a hassle than it's worth for the holder of that loan. So we'll go back in time. Let's say it's 2005. You have a loan with a prepayment penalty. You couldn't have a prepayment penalty longer than 5 years. So every year you could pay off up to 20% of your loan balance without triggering that. So even if you could go back in time and find a loan with a prepayment penalty, you can pay more every month towards it, up to paying 20% of the loan balance off annually.
All right. Cool stuff. Got another super chat coming in here. Guys, if you're watching, you appreciate this content, you like being here, like what Josh and I are doing, give us a thumbs up, help us share the message here. And, I was talking to Josh last time and before this one as well. We're starting to get a lot of super chat money, and trying to think of a way that we could use this to benefit the viewers in some regard, right? I mean, I appreciate what you guys are doing and putting it out there, but was thinking of a way that we could give back in some way to a charity, to a foundation, potentially a grant to a home buyer, something that relates to housing in some regard. So I'll ask you guys, if you have something in mind, something that's important to you, a good idea, email me. I'm open to hearing it. It's not a lot of money in the big scheme of things, but each week it's $100. Last week was almost $300. I mean, you add that up week over week, that could be a decent donation or gift to someone. So just keep that in mind, guys. So we're gonna put this money aside, and I'll figure out some way to get a ticker going or something to show you what's there. I know you can do it in OBS, some sort of overlay. So I'll have to talk to a pro out there. But Immune just gave $20. So thank you, Immune, for doing that. Appreciate the super chat. It's awesome. It's going to go to help someone. We're going to figure that out. So Antonio has one here. Can I force a seller to sell? So thank you as well for the super chat. Closing in 5 days. Agent says repairs will be done in 2 days from closing, but haven't been started. Can I force a seller to sell? No, not really. Yes and no. So in the state of California, you have a document called a notice to perform, right? And you can send it out. How the real estate purchase agreement is written, if you don't change it, it's 48 hours. So you can send a notice to perform 48 hours before you need them to perform or whatever. And if they don't perform at that time, you as a buyer or you as a seller have an opportunity to back out of the transaction. The tough part here, you're on the buy side. So very little you can do to force the hand of the seller, because if you threaten to back out and they don't want to back out, I mean, they want to stay for whatever reason, dragging their feet, they could use that as an opportunity to back out. So, it's a tough thing, but I would tell you, hey, if the agent if you got 5 days, the agent says they're going to be started in 2. I've been in that position many times where I've been on the listing side, and we, because depending on the repairs that need to be done, we didn't start them until the very, very end. So that what they're doing there isn't completely out of the ordinary. I think it happens more often than you think it does. But in 2 days, figure out where they are, see where repairs are, and maybe continue to follow up, and you'll be able to do a final walkthrough to make sure they're done. Your other option is, closing on it without those repairs being completed. Not that you want to do that, but the seller did agree to do certain things, and typically there's some sort of verification of property. In California, it's called a verification of property, condition form, and if something's not done, you put it on that form, and both parties need to sign it, but that would require you going to court and so on and so forth. So there's a lot going on there, but I would just trust the process at this point. There's no reason to be alarmed just because they're not done and you still have time, even though it's only 5 days.
They generally always find a way to work their way out. And the long answer, Antonio, you can't always sue. You have a contract. You can sue them for performance. If they say, I'm not doing the repairs, I'm not going to sign the grant deed, I'm not moving forward, I don't want to sell my house. Yeah. They have contractually agreed to sell you the house. The lawsuit or mediation, arbitration, all that fun stuff, those are all options available to you. They're just not fun, and it's usually better to just move on at that point.
No, absolutely. But I mean, technically you have a contract, so you're protected. Just depends on how far you want to take it. So hopefully that was worth your $5 there, but appreciate it. Jennifer saying the Habitat for Humanity, good organization, great organization. They do a lot of cool stuff. Trying to think of something that doesn't get, more of the not local level, but something that doesn't get the public funding, right? Where can we go to actually make a difference somewhere? I think that would be cool.
One of the, Jeb, the one that I had mentioned to you earlier is a company, a charity called the Illumination Foundation. They're here in Orange County. I think they focus California wide. It's basically to help homeless people get off the streets. They have different levels of services. Jeb and I used to contribute and volunteer for a charity here in Huntington Beach called Off the Streets, and they were super local here. They weren't only Huntington Beach, but Huntington Beach and Huntington Beach adjacent, helping people who had jobs and had some income, who had hard times and lost their home, get off of the streets. So it's funny, what you do on a daily basis kind of informs what you want to do. Jeb and I's expertise is in housing, and we get to make our living and support our families by helping put fairly well-to-do people into homes. Even if you're buying the lowest level condo, if you qualify to do that, you are well off by standards. We are all lucky and blessed to even think about owning a home, making money doing homes. So anything that you guys have, any ideas that would relate to helping people that aren't fortunate enough to be watching YouTube videos about learning how to do their best buying a home or investing in real estate, it's kind of what we'd love to do. No,
that's awesome. And I just saw not to take the focus off what you said, because that is important, but Immune made the donation said that he got a stimulus feeling generous. You're getting low on the 805s. Here's a 20 for a cold 12. So I think that was awesome. So I
appreciate it.
Yeah. So I just took that 20 and I'm giving it to a charity. So that's he's going to have to come back. Joey wants it for his down payment. We thought it would be cool. The proposal was potentially do some sort of, grant, like, the one that's been proposed, but not to, to everyone in this case. But it's just, it's too hard to monitor that to go. You'd have to have some sort of application process. It's a lot for a one-man show, perhaps two-man show to take on over here. So I don't know that that's going to be an option, but let's go here. We got another donation from Christian O. Kristen O. My appraisal is scheduled for tomorrow. How long does it normally take for them to finish and provide a copy of the appraisal? Is it same day? Typically not same day. I would say that, Josh can probably add to this, but my understanding right now in this market, well, I know appraisers are backed up for one, but they have a specific deadline that they have to abide by with their management company, the appraisal management company, of when they need to turn in that appraisal. Typically I think it's about 48 hours after doing that appraisal. Josh, and then once that happens, it has to be reviewed by the lender, and then you would receive a copy of it at that time. Josh, you want to add to that?
When they accept the assignment, they're saying, I will inspect by this time. Actually, they don't say when they're inspected by. They say, I will take the assignment and I will return the report by this date. So generally, the fastest you're going to see it is about 24 hours after they finish. The longest is going to be about 72 hours. So most times, right around 48 hours, you're going to get that appraisal back. We got one first thing this morning. It was inspected Sunday afternoon. So just about 48 hours. And that one this morning included the time for the review. The appraisal management company gets it back. They do a quality control review, and they're going to go back and say, hey, answer this question, or we want an additional comp, or we don't like that comp, or we want a comment. And depending on the difficulty of the appraisal or the quality of the report you're getting, there can be a couple of those, and it can add another day or so onto that timeline.
All right. Awesome. Immune, another $1.99. I think he's there. Appreciate it. What are your thoughts on a USDA versus an FHA loan? Anything you want to shed on that, Josh?
So I will be the first to admit, of all my areas of expertise, USDA is not one of them, but let's look at a couple things there. Things in USDA's favor. I believe it has lower mortgage insurance. You don't have to have a down payment.
Right.
And one of the unknown or lesser known benefits of USDA, if your appraisal comes in higher
Yep.
than your purchase price, you can use that amount to cover your closing costs. So not
Yep.
only can you get in with zero down, if it appraises for more, you can get in with zero out of pocket. So other things being equal, the rates are very similar to FHA, lower mortgage insurance, lower down, and the ability to borrow a little bit more to cover your closing costs. I would say most times that the USDA would come out ahead.
Yeah, the thing to keep in mind though, USDA has income limits, right? FHA does not. USDA has certain, you have to be within a certain map. So depending on where you're located in the country, USDA may or may not work just based on, is it in a rural area? Does it qualify as a property that USDA will finance? So there's a couple of things there. USDA can't use for any sort of investment property. So you couldn't buy a duplex or a triplex or anything like that. You can't have anything that makes money on the property. In fact, I think it's only for single family homes, USDA, not condos at all. Whereas FHA allows units, allows condos, that sort of thing. So there's definitely some differences there. But if you're in an area where you can get a loan on both, Josh says the numbers never lie. Get a comparison. Get a USDA comparison versus an FHA comparison. Have them break down, see what your fees are, see what your costs are, see what your monthly payment is, and see what makes sense, and use that to make your decision. So, all right, got some good questions here, but the donations keep rolling in, so I'm going with those. Dano Lenader. We had Dano Lenader last week, and we couldn't pronounce it, and I think we're still there. Let's see here. In this hot of a market, Sacramento, is it reasonable to compromise on repairs and credits? There's small leaks in bathroom, jetted tub. Yes. I mean, to some extent, I think there is some compromise on both sides. I mean, obviously the seller's compromising less in most cases, but yeah, I definitely think there is some compromise there. But you have to figure out what's important to you, right? I mean, what does it cost to repair the small leaks in the jetted tub? Does it make sense for you just to move forward versus having to start the process over and potentially pay more for the next property because of values increasing? So take that into consideration. But you're in contract. Most sellers don't want to lose the buyer that's under contract because there's time invested. They've mentally moved on in a lot of ways and are willing to work past it. So, find your line in the sand and stick to it. But be willing to stick to it if things don't go as planned. But you can play hardball. I mean, in most cases because of you being an escrow. So put it in front of them and see what it says. And if that's not an option, if they say no, say, well, I want to have somebody come out to figure out what it's going to cost to repair it, have a plumber or somebody come out that specializes in fixing that, tell you what it's going to cost. And then you can make the decision from there, whether it makes sense to you.
You probably want to take out that jetted tub anyways and put in a giant walk-in steam shower because kids take baths. Grown-ups take big steam showers.
There you go. Keep that in mind. I'll keep that in mind. Actually, yeah, I was about to say I don't even have a tub, but I do have a tub. Here we go. With all the outlandish home offers, how does it affect appraisals and what is required to get an appraisal waived? So outlandish home offers affecting appraisals, nothing happens until that offer is closed escrow. Once it's a closed property, then it can affect the appraisal if there are more to justify it, right? I mean, it's, if you have one that's way out of the norm or one that's way below the norm, a lot of appraisers are just, again, like in any sort of math calculation, when averaging numbers or what have you, maybe you extrapolate the high and the low, and then you use what's there. So if there's one that's completely out of the norm, chances are that's not going to be the new comp. But if you have a couple that are around there, then those become the new comparables. So until they're closed, they're not not really used as comparables. And then the second question, what's required to get an appraisal waived, Josh?
There's actually a chart for it. Needs to be owner occupied. You can't get them on non-owner occupied properties. Needs to be a certain loan to value. Needs to be one unit, so condo or single family residence. So both Fannie Mae and Freddie Mac have slightly different guidelines. The biggest and most irritating one for us in Southern California is the property cannot be valued more than $1 million.
So not the loan value of the property.
The value of the property. So a lot of times, we're doing a refinance. Someone owes $300,000. Their home's gone up to $1.2 million, $1.3 million, $1.4 million. We have to be very careful to put in $999 as the value, because that will probably get a waiver. Magically, if we put in $1 million, it doesn't get a waiver. And I actually saw a commentary from a guy that actually owns an appraisal management company. And imagine this: he doesn't like waivers, and he thinks it's perfectly logical that those folks whose homes have appreciated to $1.5 million or $2 million shouldn't be eligible for waivers. So it's I don't know that we're going to see it change. Both Fannie Mae and Freddie Mac, in their charters, it states that they were created to provide affordable financing for Americans to buy homes. When you start getting over $1 million, although, and this probably sounds crazy to some of you people in other parts of the country, I have people buying $1 million homes that are not wealthy people. They're by no means poor, but they are not wealthy people. That's what it takes to buy a decent 1,500 square foot, 3-bedroom, 2-bath, 1960s tract home. So I think it's a little weird that we have this thing in the United States that because someone lives in an area where those costs are high, they shouldn't be eligible for the same government benefits that someone who is in a lower cost area. We really have some weird stuff around that. And at the end of the day, what we're trying to do, the whole reason why they came out with waivers, is saying, is this necessary? An appraisal is there to protect the lender. It does provide you some certainty that the home is worth what you're paying for it, but really it's there to guarantee the lender that the collateral, the property, the collateral for the loan actually secures that loan. That if you fail to pay, that they will be able to recoup their funds. And if someone owns a $4 million house and they owe $300,000 on it, we shouldn't ask them to get an appraisal just because their house is worth $4 million.
I agree. I got some good comments coming in here. The best one I've seen so far is this one.
I knew that was going to be the one you were going to. I saw that the minute it came in.
I read it and I immediately visualized the comment, and it was scary, like sitting in a clawfoot tub. Those things
like eagle claws, like the eagle there in the picture, the eagle claws on the corners of the tub.
Exactly. Genius. All right, we're going to move back up here to some that we skipped over earlier. Give me a second here. So Joey's again had a couple questions here, but this is a common question. What does it mean to be an attorney state? So some states have escrow companies, some have attorneys, and it's who does the closing at the end. California, for example, is an escrow state. A lot of the states on the East Coast seem to be attorney states, and I don't know why one is that versus the other. But it just means an attorney does the closing and looks over the documents versus an escrow, which both are third parties, right? They don't work for the seller or the buyer. They are essentially an intermediary, if you will, between both sides to facilitate the transaction.
As soon as I say this, I know we're going to have an attorney who specializes in closings comment over here and say I'm a bad person for saying this, but it's an archaic way of going about it. Attorneys are not necessary in the transaction, and I'm certain that they have paralegals doing most of the work, but it adds, if you ask people who are doing loans, who are doing real estate in attorney states, it adds time and expense to the transaction with very little, if any, benefit. But once something is done a certain way, it just continues to be done that way. I'm not saying that escrow closings or title companies handling closings are ideal or the only or best way to do it, but anything that we can do to reduce costs and shorten timelines is welcome.
All right. There you go. Josh's opinion. Don't hold that against him.
That's my 2 cents.
His 2 cents. All right, here we go. I'm trying to find some here. Logical Thinker has one. If you find one, you put it up there after this. How much should buyers in Orange County estimate that their closing costs will be? I don't know that it's Orange County or just, well, I guess if you're in an attorney state, it could vary a little bit, but I tell clients, you need to have 2 to 3% probably for closing cost. and all of that money isn't going to the lender. All of the money is not going to escrow. I mean, part of it is if you impound your property taxes and you do other things in there, I mean, it's going to add up. And I think it also depends on your loan amount in some cases as well. But Josh, what are your thoughts on closing cost percentage?
So here's what we will always start the conversation with. Most buyers and borrowers don't understand there's closing costs and prepaid items. They're two very different things.
No, that's fair.
The most common misconception I get in some of the forums that I moderate for, someone will say, my lender's nuts. He says I need to pay $8,000 in closing costs. You say, okay, well, send me over the loan estimate. And he's actually got $4,000 in closing costs and $4,000 in prepaids. Prepaids are the amounts required to establish your impound accounts and or prepay things at closing. When we say things, specific things, interest, insurance, property taxes. So when you buy, you're going to have to pay, whether you're impounding or not, you're going to pay the first year of property taxes. You're going to close on a day in the month, and at the first of the next month, you're not going to make a mortgage payment. So if you close on the 15th, there's 15 days of prepaid interest. And then for property taxes, again, even if you're not impounding, most times of the year, there will be prorations. The seller will have paid property taxes for a portion of the time you're going to use, you're going to pay them back. So in California, where we are, because in California's infinite wisdom, we pay our property taxes twice a year, but not every 6 months. So certain months of the year, we need to collect 8 months of property taxes to set up your impounds. Other times of the year, we need to collect 4 months. So in general, I'm telling people that you should be looking at closing costs on a $500,000 transaction is about $3,000 to $4,000 isn't a normal and acceptable range. If you're buying in the $1 million range, you're probably up at around $5,000 to $7,000. Now you also have prepaids, and I would generally count on doubling that. Sometimes of the year your prepaids are a little bit less, other times of the year they're a little bit more, but it's generally double what those closing costs are. And the most important thing that you can do to control that, lenders, direct lenders, like historically, you go back to the 90s, every lender was going to add $1,000 to your closing costs. And over time that crept up to $1,300, $1,500, $2,000. Now, for the most part, most brokers and a lot of lenders are not going to charge you fee. We roll it into the interest rate so you can see it. So if you go to a direct lender, you're going to have another $1,000 to $2,000 of closing costs on top of what I just quoted you. That's the biggest thing you can do to control it, is to make sure you're working with a lender that has a competitive interest rate without charging you junk fees.
All right. There you go. Got a couple good questions coming in here. Glenn had one. I laughed out loud when I read it. Going to have to Google what is impound. Sounds like you're paying someone to go mow down your house. So impound escrows, taxes and insurance. It's added to your monthly mortgage payment, so you're paying them up front versus twice a year or once a year paying your insurance or what have you. So just it impounds here in California. Some people call them escrows, all the same thing. And then we got John Jones too, throwing Doge out there. Yeah, John, I've been watching that. I did watch it pull back about what, 20%? No, actually more than that in the last day. But yeah, my little $1,000 investment would be like $6,000 right now. Not 60. 60 would be a lot. I'd be pissed. 6, I'm still not pissed, but I know probably should buy it this time next week. Thing will probably be $1. I'll be mad, but anyway. Let's see what we got here. Another question here. Do you have to go to a lawyer for closing? He's talking about the question that came up a moment ago where we were talking about attorney states. Essentially, you're going to an office that is affiliated in some regard with that attorney. I don't know that the attorney per se has to be at. Josh, do you know, does the attorney actually have to be at the closing, or is it someone from their office that facilitates that?
I don't believe they are at the closing, but I would love to hear from someone in an attorney state who can confirm or deny the veracity of our claim. I was just wondering where Andrew cheerleads, because those other two cheerleaders are a little smaller than him. I'm assuming he's the one that holds them up on top of the pyramid.
I know. That's great. Yeah, I can't even see what the actual full pit. Where is he? Yeah, maybe they're his girlfriends. Good for you, Andrew. Solid deal there. Another easy question here. Michael DeRee is asking 20% required to refinance. Easy answer is no. You do not need 20% to refinance, but you do need 20% to get rid of PMI. That's the easy answer to that. Let's see. I'm going back up here, Josh, trying to get some of these ones that we missed. Here's one from Rose. Did we answer this? I received a counteroffer saying to close within 21 days, but my lender says that's unrealistic. What should I do? Find a new lender. I don't know.
The new lender.
I find out how soon your lender can close. How quickly can they get it done? We got Josh and I have one right now, 25 days. So we cut it from 30 to 25. Could we have gotten it done sooner? Maybe. I didn't want to push it any further. I didn't want to put any more strain on. I didn't even ask Josh if we could do 25. I just put it in the contract and sent him the contract, and it got accepted. So I figure he'll figure it out one way or the other. But I knew that, a lot of the loans are getting approved well before, when they actually need to close. So, we do enough loans together to kind of have an idea of how it works. But to answer your question, in simple terms, it's not unrealistic that a lender can get loans done in 21 days. I have enough lenders on my Facebook and Instagram and whatever commenting all the time that, a deal fell apart with one lender, ended up with this lender, and they were able to get it done in 14 days or whatever. So there, it can happen. But some, depending on who you're with, a bigger bank, those, types of companies typically have more issues getting those timeframes. Brokers typically can make things move a little faster.
So let's pick up on that piece of it. Largely, It depends on the channel that you're working with. We just closed one yesterday. It was a 20-day close. We did nothing special on that. We just did our job, and it closed in exactly 20 days on a 20-day contract. If someone comes and says, "Hey, can we close in 14?" The question is going to be, "Show me the client. What client are you asking about?" Many of them, yes. Like you guys saw Lupe on the call last week. Lupe and her husband, Ray, absolutely. We can close that one in 14 days if we had to. There are other clients that I would look at and say, no, we're going to need the full 30, and this is why. But for the majority of clients, 21 days is very doable. For someone who's efficient and has good processes. If someone just says, hey, 21 days is not doable, ask them, what about my situation is so complex or difficult that you're unable to do that? Because it's not like we were just laughing in my office last week because it feels like 5 years ago. But last August, it was taking about 45 days to close deals. That was when rates had fallen to their lowest level.
That's when I refinanced.
It was when Jeb refinanced. Rates had fallen to their lowest. Everyone on the planet was refinancing. Lenders were still adjusting to working from home, and it was hell. And it seems like it was 5 years ago. We're like, wow, that was like 8 or 9 months ago. Now enough lenders staffed up, the market calmed down, and everyone loves and focus on purchases. Refi is going to sit to the side because all we have to do is just wait till the next day to close. There's not a seller waiting with moving vans and things of that sort. Purchases always get prioritized. Unless there's something really weird or unique about your situation, a lender should be able to close that in 21 days. And I will tell you, my office will bleed out our eyes to make a deal happen before we say, hey, no, go find another property, because it's impossible to get a property under contract. So if the answer is we have to close in 14 days for you to get a contract accepted, we'll figure it out, because we're not going to lose that property and have you go back out there and fight those wars any longer.
There you go. If you're here, you haven't done so already, do me a favor, hit that like button. I hate asking that, guys, but I do it because you guys typically do it when I ask.
And Andrew came back and filled in the gaps. He's a firefighter at the race course, so they were showing their appreciation for the firefighters.
Well, I think that's a reputable, definitely great career. But yeah, that's good for those girls.
Jeb and I are going to ask our wives if we can be volunteer firefighters on the weekend. So Andrew, you find out if we can get in on the course.
Yeah, we'll come down there and visit you. Can you shed some light on how appraisals for new construction work? Do they come to value? So typically appraisals on new construction do come in at value. They work the same way other appraisals do, but the difference is they're using typically properties within that development. And the sales office can provide enough information to help justify those. I haven't seen any issues on new construction, or ever heard of any issues on new construction. Typically it's on resale that if you have appraisal issues. There was another good one here. So I'm going to leave it with that one. What's the implication of paying off an investment home and keeping a mortgage on your primary home? No implication at all. I would tell you which one, where's the greater benefit? Does one have a higher interest rate? Like what would be the reason for paying one off over the other? Outside of that, I mean, where are your biggest savings going to come from? So anything add on that, Josh? Anything I'm missing there?
So there are tax laws that limit what you can deduct in terms of interest against your primary residence. No limitations on that investment property. If you borrow against the investment property, you can write off the interest against the income that's coming in. As Jeb said, you're going to have a higher interest rate on the investment property versus your primary residence. So those are the two things to look at. But yeah, numbers never lie. Pencil them out, look at each one. Other things being equal, I might prefer having my primary residence free and clear and keeping the tax benefits of the other one, because again, the world goes to hell and I lose a property. I'd rather lose my investment than my primary.
There you go. We're working our way down, guys. We're close to getting caught up here. Michael's got a couple of questions here. One was that, and let's see where the other one was here. His first one was, how is it possible for a home to be pending after 5 minutes on the market? Something seems wrong. Sometimes agents put homes on the market, for comp purposes, that sort of thing. So sometimes transactions go into escrow before they're ever listed. So that does happen. So that could be the case that you see something go on the market and immediately go into escrow. Outside of that, and just weird things happen out there, and depending on how things update. Second question, we were told that our loan was pre-qualified. Letter was that they were basically pre-qualified through auto underwriting. What's the difference in that and it going through underwriting before closing, Josh?
It's always going to go through an actual underwrite, but 99 times out of 100, we're going to use an automated underwriting system also. The automated underwriting system is sort of a pre-underwrite, but it's not just a pre-underwrite, because the real underwriter is going to use that tool. We set up your loan application and get everything dialed in. So if I send you out to my portal to do an online application, you complete that, we don't just take that and submit it to the lender. You don't know how an underwriter calculates your income. There's going to be some gaps and some missing pieces of information. So we go through, scrub it, clean it, and then you're going to run it through the automated underwriting system. It's garbage in, garbage out. So if we've done a good job, validated the information, put good information in, it's going to kick out a list of conditions. And that is what the actual underwriter is going to do. They're going to do the same thing. They're going to look at my income calculations. They're going to look at the assets. They're going to look at the credit report. They're going to look at the appraisal, and they're going to make sure that that's quality information going into the automated underwriting system. And then the conditions that the automated underwriting system kicks out, they're going to make sure we've provided that, or they're going to condition for it. So it's not really an either or. There's no situation where you can just have automated underwriting. You can have a file that is only manually underwritten, but you can't have a file that's only automated underwritten.
Yeah, and I mean, to explain it in just a couple of words here, the underwriting is verifying the information that was put into the automatic underwriting engine, right? So as Josh does files a little bit differently, where they, scrutinize the hell out of the file initially to make, and put accurate information in. But I will tell you, it's the information's only as good as the person that input it, right? So you can make automatic underwriting approvals all day long with inaccurate information. That underwriter isn't taking your inaccurate information at face value. They're saying, I want to see those same documents. Let me verify what is being said here and confirm that you're good to go. So sorry, Josh.
No, it's dead on what it is. Like, probably the biggest thing that we have is borrowers don't understand. They go, no, this is my income. Why does it say this? I know you know what your income is going to be on your next paycheck. That is not necessarily the income that your underwriter is going to use. If you make $125,000 a year salary, that's simple. We divide it by 12 and that's your salary. But if you have salary, you get some overtime, there's a bonus, all that stuff is calculated differently, and we have to document it differently. So there's multiple things that have to happen. And just the last thing on automated underwriting, there's a genius here in Southern California that has a just spams every realtor with his list. And he's always talking about, we can get you a guaranteed DU approval in minutes on the weekend so you can write your offer. A DU approval is not magic. DU stands for desktop underwriter. For Freddie Mac, that's Fannie Mae's system. Freddie Mac's is loan product advisor. There's nothing magic about them. Anyone can put anything in. I get, you guys ask all the time, what's a cross qual? Why do I have to do it? What does that mean? A lot of times an agent doesn't want me to do a cross qual. They want to send over the pre-approval pack and say, will you look at this DU? And oftentimes you can read between the line and just see this is garbage. And like everything is round numbers. Every balance in every bank account is a round number. Every income is a round number. It's very rarely. They're all unique, funky little numbers. So there's things that you can look at and pick apart. So DU, it's a tool that is used, but it's sort of like an axe. You can either use it to knock down a tree or you can kill someone with it.
Wow, that was a hell of an analogy there.
We took a left turn with that one.
Jesus, holy cow! We just wowzers. So Seer Guru, also a regular commenter on videos and everything, says put an offer in on a property, and I'll throw it up there. Sorry, and the agent said they're going to disclose all offers. Holy cow, that's a unique way of responding. Yeah, that would be. Yeah, I don't even know. I mean, I think as agents aren't ethically supposed to disclose other clients' offers. So
you'd have to redact their information.
I'm not 1,000% sure. I mean, ethically, I don't think you're supposed to do that. Legally, I don't know that there's any set fast rule on that. I mean, I never disclose anybody else's offer, but you can give people, ideas of things, but you can't, disclose all the offers. I don't think that might not be right, but that's what I'm sticking to.
We have an urgent question here.
All right, an urgent one. Where's the urgent question? Asked
a couple times. Is Untouchable EP says, please answer. My lender is telling me my closing costs will be $12,000 to $14,000 on an $820,000 purchase. My initial inclination is to say that's batshit crazy, but then I want to back up and say, okay, what could be happening there? Most likely you're dealing with a direct lender who does charge lender fees, and they've added $1,500 to $2,000 of closing costs there. I would expect between escrow, title, appraisal, credit report, reporting, all of the third-party stuff on your $800,000 purchase, it's somewhere between $4,000 and $5,000. So now we add another $2,000 for the lender in there, and you're at $7,000. 820, you could be in an area with Melrose really high property taxes, so we could have a big chunk needing to come in to set up the property tax escrow impound. Maybe it's in a fire area with really expensive hazard insurance, but it just sounds really high. It sounds really high. That shouldn't be over $10,000. You're in California, so I did ask that because I know other states do have higher closing costs, and it could be more normal for the area. But we'll throw up my email address. Send me your loan estimate. Let me take a look at it. If we can save you some money, I'd be more than happy to do it. That sounds high. It sounds high by $2,000 to $6,000 relative to what could be done. The other thing that can be in there is points. There's a lot of lenders, the giant radio behemoth that blasts you with ads every time you turn around. They're famous for quoting really low rates, and then magically when you get your 0-point loan estimate, it has 1.5 or 2 points in there. A half a point on an $820,000 purchase, say you're putting 20% down, $600,000 loan, that's a half a point's $3,000 or $4,000. A full point is $6,000 on that loan. So most likely there's some points and lender fees in there. It could also be high insurance or a high tax area would be my other guesses. But by all means, here, we'll throw up the email right now. Shoot me a copy of your disclosures and your loan estimate. We'll be more than happy to go through it. If it all makes sense and checks out, we'll be more than happy to give you peace of mind that your lender's doing a good job for you. That does happen. I would say every fourth or fifth person that contacts and says, hey, will you look at these numbers? We go through it and go, there's valid and rational reasons why this is here. And yeah, we could also do the loan for you, but it's not going to be significantly better than this. But most of the time, it's just a high cost lender that you're working with.
There you go. So enough time to jot that down. We'll put it up at the end as well. Renil Ebrio. Is it easier to make a deal if your agent and the listing agent work for the same company? I would say no. It makes the deal easier if you got a professional on both sides, two people that want and have a common goal to get the transactions done, and both have, everybody's best interest in mind. That's how deals get closed. Now, in some areas of the country, you have smaller type brokerages and that sort of thing. You might have some, better interactions if both agents are with the same company. I don't think that necessarily matters. I mean, I'm with Coldwell Banker here in Southern California, and we have tons of offices, tons of agents. I mean, I don't even know how many agents we have. I probably should know that here in Southern California, but I would say 1 out of every 5-6 deals is somebody from Coldwell Banker, but not necessarily my office. Right now I have one with somebody in my office. That deal is probably going to be easier just because I know him personally on the other side. And I knew him personally prior to us going into the process. So we already know that both are professionals. It's easier to communicate that way. But at the same time, right now I have one with another agent that's at a different company in Huntington Beach, company that I was with prior to Remax. And that transaction is just as easy, and I knew him prior to as well. So I think it's all about, having a good reputation in the business and doing your job as you're supposed to, and things will run smoothly. So to answer the question, I don't necessarily think it makes that big of a difference as long as you got 2 good agents.
Hey, Jeb, I want to
Yep.
follow up with this one. Our friend Michael Dury, with a much prettier pair of gloves there with the wonderful Dallas Cowboys star, says he's got $12,000 in closing costs out of pocket on a $232,000 loan in Texas. So one of the things I know about Texas only pays their property taxes once a year. So you can have a much bigger lump at closing for your property taxes. That's possible. Even if that $12,000 sounds like a lot for a $232,000 loan. So Michael, you have my email. You watch here every week. Shoot me your loan estimate. I'm going to have one of my friends in Texas take a look at it, because that sounds like an awful lot of money.
There you go. Yeah. Is it Randy?
Randy Tickle can handle it. We got a lot of folks down in Texas.
All right. There we go. Let's see here. Mr. 722. Wow. I'm dyslexic. 2743. We're about to get in a bidding war on a million plus home, Manhattan Beach, that is owner occupied. What advice would you give regarding showing up and talking with owners, agents in hopes to win? Bidding war in the sense that you've already put in an offer and getting something accepted, or you're just starting the process and it's going to be a bidding war regardless. I know the Manhattan Beach market is insane. That whole South Bay area is. So, just got to put your best foot forward. What I would tell you is go in with your best offer up front. Don't expect to get a counter offer. I'm seeing a lot of agents in this market only send counter offers to, top 2-3 offers, maybe top 5, because some of these properties are getting 20-30 offers. And it's a lot of work for the seller. It's a lot of work for the agent. It's a lot of work for everyone to send a counter offer to people that weren't even in the top echelon, if you will. So just come in with an offer, that you feel strongly about, that if it doesn't get accepted, you don't have regrets, and, put your best foot forward. Outside of that, meeting with the owners, going to be tough. You could ask to present your offer in person. It depends on who the client is on the other side. I think you're going to have a more difficult time with that, just based on pandemic and everything going on at the moment. People being face-to-face and that whole thing, depending, regardless of how you or whatever feel about it, it's out there, and there's this kind of stigma around, face-to-face interactions. We can't even do open houses in the state of California right now, which is absolutely insane. Just based on where things are. I'm okay with it, but it's just, that's where things are. So present your best offer, again, shorten contingencies, maybe shorten your escrow period if possible. Take unnecessary fees out of the contract that, you're asking the seller to pay, like home warranties, that sort of thing. And maybe escalation clause could help you stand out. So hopefully
Jeb,
that's helpful.
We got a live follow-up here. He gave you some more information.
So you put it up there. It's insane. The offer will be about 200 count over asking what we're thinking. I'm asking about the interaction, physically meeting the owner and the listing agent. You can try it. You can ask to do it for sure. It's definitely an option. If you're there and showing the property or viewing the property when they are there, that's a really good time to interact and kind of mingle and do that, little chat to hopefully set you apart, ask the right questions, find some things in common that you can use to, have them remember you, or, maybe pick your offer. Outside of that, I mean, you might not ever interact with either of them, depending on who your agent is. Most times sellers or buyers have no interaction with the seller at all. I mean, your agent and the other agent are the two people that are working through that deal. And that's not going to change unless you're able to actually have a face-to-face meeting. And again, what I mentioned a moment ago may or may not work for that situation. So hard to say. All right.
I got a good one. I got a good one, Jeb. I got a good one. Poor Trader, which I like his little bull bear fight there. And we have some people with either really good pictures or really cool logos. I need to get one of those for my little thing when I comment on other people's videos. But Bank of America is offering a no PMI loan with 3% down. Is that a no-brainer going with them? I don't have any more than 5% down. So if something sounds like bullshit, smells like bullshit, and looks like bullshit, it is bullshit. What Bank of America does with this is they don't charge you the mortgage insurance. They are still buying mortgage insurance, and they will have a higher interest rate, and they will have some lender fees in there. They are a for-profit company. They are traded on Wall Street. They don't do anything that they want or need to lose money on. So you're not saving any money with them. By all means, check with them, get a quote. I mean, the best example I can give, we had a doctor a couple of years ago that came to us, and all of the big banks, Bank of America, Chase, B of A, they do these doctor programs where they can put 10% down, no mortgage insurance. They'll ignore student loans, that type of stuff. And the borrower said, well, this is amazing. They're doing 10%, no mortgage insurance. And we look at it, we run the numbers and say, I don't have a doctor program, but my terms are exactly the same. He's like, no, they're my bank and they're doing a good job for me, so I'm going to stick with them. So again, the numbers don't lie. Compare it with an actual local lender that's going to give you good service, close on time, and not tell you it's going to take 45 days to close, and look at the numbers. There's no magic out there. There's no lender on the planet, bank, direct lender, credit union, broker, that's going to sit here and say, you know what we want to do? There's a certain class of borrowers we'd like to lose money on their loans or not make nearly as much money. We have margins, we have overhead, we know what we have to meet on these loans, and that's the same for me, little broker with 5 employees versus Bank of America with 500,000 employees. They're making money on those loans. There's no magic. There you go.
All right. Let's see what we got here. I just saw one just now. So here we go. Sorry. Monster 92501. So 92501, that's got to be somewhere here in Southern California. Not sure that do you know what's going on?
I'm not laughing at him. Joey Crack is battling back that he thinks his gloves and his team are nice. No one likes the Broncos. No one outside of California likes the Broncos.
Vianney likes the Broncos.
I don't know how. He's never even been to Colorado.
So Monster 92501, somewhere here in SoCal, not sure where that zip code is, but landlord has accepted my offer to purchase home I've lived in for 9 years. Landlord's agent offered to represent me as well for a flat fee. Don't know how much. Thoughts, pros, cons. So yes, you're correct. You went on to say, doesn't seller typically pay for agent's fees? And the answer is yes. Yes, typically the seller would pay for those fees. I'm not sure in this situation how that's being presented. So it sounds like you made an offer directly to the landlord and then a realtor got involved after the fact. But, maybe a question to ask is, I don't even know what question to ask. I mean, if you've already presented the offer, maybe verbally, if you haven't, maybe put something in writing with an agent. You're welcome to use the listing agent, but make sure, if you decide to do that, I mean, it sounds like your price has already been negotiated, so you don't really have to worry about that. Just make sure that the person there actually knows what they're doing. They're a professional. They have experience and what have you. And they're not just there representing the seller, because there may be things that, you've lived in the property for 9 years, so you probably know the property better than the seller in most cases. You know all the problems, what needs to be fixed. And so you might, you still need somebody to represent you if things do come up in an inspection or you want repairs or what have you, and they're not just there on the seller's behalf. So keep that in mind. But, if not, and you're making an offer, you can find an agent, and that agent can make an offer. And part of that, they can do a an agreement for compensation on there that the seller sees and has to sign and what have you, so that they're compensated through that transaction and what have you. So, that there's a couple of unknowns there with it kind of sounding like maybe a for sale by owner with an agent. I'm not 100% sure on that.
Jeb, let me step in for Monster and kind of ask some questions. So I'm saying, okay, if I'm in his shoes, now I have the advantage of 26 years in this industry. If I'm a seller needs representation. A for sale by owner is not going to make all of the disclosures that they need to cover their ass. So they're going to screw up and they're going to expose themselves to liability if for whatever reason they upset that buyer or something goes sideways. As a buyer, what is a buyer's representation? Now, let's ignore that this is the landlord's agent. Let's say it's another outside unique agent that says, hey, if you pay me, I know you're in a for sale by owner transaction and they're not paying a commission. If you pay me $1,500, I will represent you. If we've already settled on a price, if we've done the negotiations, what is an agent doing for me as a buyer?
I mean, representing, trying to help you get the best out of that property, right? I mean, that buyer would be there to help negotiate on your behalf. So yeah, I mean, I can see your point as a seller not wanting to pay that since the transaction is already in place and a price is agreed upon. You
would say like helping me get a good inspector, get the inspection done, then go back and negotiate the inspection with the seller. Anything that comes up through that process that
appraisal comes in less, we're trying to negotiate that, right?
So in that situation, why in the world would I want the landlord's agent representing me? I would want to go find a Jeb and say, hey, I've already negotiated the price. Will you represent me the rest of the way for $1,000 or 1%, whatever number you guys negotiate?
No, but I mean, to go back to that point, as a seller, I'd be like, well, I'm not paying your agent at this point. We've already negotiated. I mean, I can see a lot of sides to this whole thing playing out, saying, hey, look, we've negotiated. I've got my agent that I'm willing to pay. I'm not willing to pay a buyer's agent because we've agreed upon it. This is on you to figure out. So, because they're getting their paperwork done, they're dotting the I's, crossing the T's. So there's a lot going on there. Anyway.
Okay. Jeb, you did a great job answering that, but I now have to apologize because I have now started fan-on-fan violence over here in the comments. We've got Cowboy fans and Bronco fans just attacking each other in the comments. So I'm not going to talk about anyone's gloves anymore. You guys can wear whatever gloves you want.
It's all about the Panthers anyway. Carolina Panthers are the team. So we're not Broncos, Cowboys. Garbage as far as I'm concerned.
Cam's
Panthers.
Awesome. Cam is awesome.
Cam,
that's your quarterback, right?
No.
Who's your quarterback?
To New England.
Who's your quarterback?
What's his face? It just got drafted.
No, Sam Darnold. He got traded to your team.
Oh yeah, traded.
You're
not
not a fan, bro. You don't even know. You don't even know your own team.
Traded. Yeah, he's going to be our quarterback for like the half a year he's there.
Hey, I just saw a comment over here from Monster. Says also, Jeb, using the lender you referred. Thank you. Monster, where are you at and who did Jeb get you connected with?
There you go. I don't remember either. So 92501. Again, I think that's Cali, but I might be wrong. Unless that means something completely different. Maybe that's a birthday.
92501. I just don't know screen names here. So it's someone we're working with and I just don't know their screen name.
That'd be fantastic. Let's see here. Steph Lopez just took a job with Facebook. However, I was self-employed before. How can I get a home? Was in pharmaceutical sales prior. Josh, throw that one your way. So went from self-employed to a W-2 salary, I assume.
Now, this is, again, one of the ones I'm talking about with these wonderful ppictures that the viewers have. She's got windswept hair. I need to find one of these photographers to get one of these wonderful photos of me. Like, my stuff doesn't look cool like that when I post my stuff.
Yeah, you have to be photographic as well.
Oh, so this face just doesn't show up well on camera? Is that what we're saying?
That's great.
So you're probably going to be okay, but probably going to need to about 6 months in that line of work. So the self-employed is, you definitely went the right direction. It's much better to go from self-employed to employed than from employed to self-employed. So we're going in the right direction, but you're probably gonna need about 6 months on that job just so we can show, yes, I switched industries. If we can make a claim that what you did as a self-employed person translates, let's say that you're a self-employed in digital marketing and you go over and you work in digital marketing for Facebook, we could probably make that case right away. But let's say, we're talking about photographers. Let's say you were a self-employed photographer taking pictures of people, and now you're over here working in sales. It's a different thing. But pharmaceutical sales, if we went to Facebook and we're doing advertising sales, we might be able to make a claim. I would count on probably about 6 months on that job, but you might be able to find a way to get away with less.
All right. Cool. So Dippa says Cowboys are America's team.
That's a fact.
I would back that if Jerry Jones wasn't there.
Jerry Jones is the best part about the Cowboys.
Oh my God. He reminds me of what's his face from the Raiders. That passed away.
That's insulting. Don't bring Raiders.
No, it's not insulting. There's saying
you're going to make a
controlling.
Crazy scrum over here in the comments if you bring Raiders fans into it.
Anyway, let's go here. Oh, that's so great. The comments are just awesome. Rod Stewart. Thank you for joining us.
We have Rod Stewart. Does he have supermodels with him?
Oh, this is so good. Wife's parents wants to give us 50% down on a $1.2 million home. What should I have them do? They are old school and skeptical about everything. So, if that money is going to be seasoned in your account for 2 months, you don't really need to do anything other than get it and use it towards your down payment.
Would be some really trusting in-laws to hand him $600,000 to put in his account.
Enough, but he's married to their daughter, so maybe they trust. Wife's parents. But other than that, they could do a gift letter, right? So at closing, they could write a gift letter saying the money is coming as a gift. They have to source it and document that it came from, wherever and show the transfer to you. But outside of that, not a lot that needs to be done, Josh. Am I missing something there?
The thing that I always tell, I had this question come up, have some clients that are getting $60,000 from their parents. And they said, hey, we're going to write an offer tomorrow. Should we have our parents dump the money in our bank account? I said, absolutely not. On a conventional loan, you have to prove the donor's ability to gift. So what we normally do to get that is get a bank statement from the donor. Obviously, many donors are like, hell no, I'm giving you a gift. I'm not giving you a copy of my bank statement. They can either send it directly to us, the lender, and cut you out of the loop. What they generally prefer to do is if they wire the gift directly to escrow, then we don't need any proof of their ability to gift other than the wire showing up from Jeb Smith's account at Bank of America and a gift letter saying that the gift came from Jeb Smith. So as long as we can tie those together, and in a situation where they're old school and skeptical, the benefit there is the money stays in their bank account. You go out and get it under contract. You make your own deposit. You get to the finish line. Hey, we're ready to close. Need you to wire $600,000. Here's escrow's wiring instructions.
All right, good. Now, this thing's getting out of control down here. We got Raiders fans now jumping in here.
I told you, don't mention Raiders. Everything goes to hell as soon as you say Raiders.
Let's see. Here we go. Dar was here. Do I need to have had savings for a long period in my account in order to get pre-approved? Should I let it sit or just apply now? Josh, how long does money need to be in an account?
So
can you use your stimulus check to buy a house?
Start with the second question. Should I let it sit or just apply now? Always apply now. It is never too soon to talk to a lender. The earlier we talk to you, the more options we have. We may talk and decide it's better to wait, but we don't have that option if we just wait. We don't have the option to not wait if we just wait. Funds do not have to be in your account for any period of months if they're sourced and seasoned. Jeb mentioned stimulus money. If stimulus money shows up in your bank account, you are absolutely fine. We can use that straight away. If we have gift funds that we can document and source, we can use them right away. If you have a tax refund show up in your account, we can use it right away. If you have a bonus from your employer, if you get a settlement from a lawsuit, millions of sources of acceptable large deposits into your bank account. But what I would absolutely say, get with an expert lender as early as possible.
All right. Yeah, there you go. And he's saying it's grant money. So if it's coming from a grant, you're fine. Just need to source where it came from.
It depends on where the grant is from. So if it's an acceptable grant money source, And one example would be an employer can give you a gift, but we have to have a policy in place, a policy manual in place from that employer that they will do that for any employee. They can't just be like, you're the boss's pet employee and they gave you $10,000 to buy a house. So again, talk to a lender, explain what the grant is, where it's coming from, let's document it.
All right. I got another good one here. Actually, let's see here. Here we go. So Vic F, in my closing costs, my lender charged me 12 months of prepaid home insurance. Does this mean I don't pay home insurance for the next 12 months after the closing date? Josh.
You do not pay it to the insurance company. You're going to pay 1/12 of it every month into your impound account, and they will pay it for you. If you put a big down and you don't have an impound account, then yes, you don't pay anything for the next 12 months. When the renewal comes due, you write the check. I'd say 80% of borrowers do the impound account. You probably have an impound account, so you paid the 12 months in advance. You're going to pay 1/12 a month into your impound account. They'll pay it when it comes due. But again, if you don't have an impound account, you will pay it when the renewal comes due in 12 months, but nothing due monthly.
Yeah. Baby boomer, Eekman, I think who's local here, Huntington maybe. Baby boomer parents made millions in the stock market and given their children hundreds of thousands of dollars for down payment. Yeah, a lot of people made money in 2020, especially from the stock market, equities and what have you. So there's a lot of money floating around. So yeah, and baby boomer parents oftentimes, but that particular case, they did say, came back up and said parents were living with them. So going to have the parents in the house as well. Horizon Music, are wire transfers of that amount safe? So I'm assuming you're talking about the 600,000. The answer is yes. Yeah, wire transfers safe in any amount as long as you have the correct account numbers that you're wiring it to. And that is where wire fraud happens. So if you're wiring any money, just make sure you have accurate information. Again, I'm not here to start talking about, wire transfers or what have you, but the state of California, wire fraud is a real thing. It's a real thing everywhere. But people hack people's emails, send information that is not correct for people to wire money, especially at closing when there's large amounts and money disappears. So just make sure when you're wiring money, you have called and verified the information you have is accurate. Let's see here. Jeb, coming up on 2 hours, your buddy looks tired. Talking Josh? Josh looks tired?
Bro, I'm not tired. Come on, Jennifer. That's rude.
He needs another 805. He's pissed that he didn't grab more.
We're down to the last of our last here, so we've got.
Well, we're running up on 2 hours, as Jennifer said. So Jennifer might be tired. She's doing a lot of moderating there. Thank you again, Jennifer. Jose.
Is everyone out there, Jeb, before we get to his question, and you're not going to get that name right?
No, I am definitely not. I was actually going to say the name.
I've actually heard people pronounce this, and I can't pronounce it right. So it's not right.
No,
it's not right. No, but we'll answer his question. No, you have to be able to speak with an accent and stuff to get it right. You're not getting it.
Like a pirate accent?
No, that's a different kind of accent. The right kind of accent. But a pirate accent would be better than just butchering the name straight up.
I was going to try it, but I can't even get there. I'll start laughing.
Don't.
So what was your deal? You were going to say something before I got
just wanted to make sure. I mean, it's 1:53:15, so an hour, 53 minutes and 15 seconds. We are only about 7 to 8 minutes away from it officially being Wing Wednesday. Depending on where you are in the country, it may already be Wing Wednesday. You may have already eaten your wings, but I will be getting my wings within about 30 minutes. So that's the highlight of being done with the call tonight.
There you go. So Josu?
Something like that.
I just added a little at the end just to make it sound good. When can I refinance my house? Currently own a 3-family rental and I have a 2.375 interest rate, but I also have to pay PMI, which is 230. I currently have an FHA loan. Is it worth it to refinance? So you're never refinancing if you're looking for a lower rate on that thing. No kidding. When you either have the equity, not sure when you bought it, if you have, 25% equity in that property being its units, do you have to have that?
I don't know, because our friends over here are trying to help us. R81 says it's Josue. Josue said fast. We probably still butchered it. So let us know if that is correct. Josue.
Answer the question. When can he refinance or she?
So here's the problem.
I don't even know. I can't see the picture. He.
Here's the problem.
Pictures are too small on my side.
Just like you said, conventional loan is going to have a higher interest. So to get out of the mortgage insurance, we have to have a conventional loan. Conventional loan is going to have a higher interest rate. So the 2.375, your mortgage insurance on an FHA loan is 0.85. So that puts us what, 3.3
Yeah.
So we can get you probably lower than that rate on a conventional loan, like 3%, but it's not going to save you that much money. If you're unable to deduct the mortgage insurance, which you probably cannot, depending on where you're at and the amount of it, then it might make sense. It's just, this is a complicated one. I don't know that it's a no-brainer. What you need to do is get with a lender that can do a side-by-side comparison. Hey, here's the current loan. Here's what a new conventional loan looks like. And then you have to make the decision whether you want to get out of the mortgage insurance. It's not going to save you a bunch of money on a monthly basis. So forget it.
No, there you go. NT follow-up questions: wire transfer versus cashier's check. Feels like I go with the wire. It's easier. Wires, I think, cost a little bit more money to do. It's easier to track, trace, know when it got received, when it got sent. There's federal numbers associated with it that show all the documentation there. Cashier's check, yeah, you could lose that thing. I mean, there's some other things that could happen with that. So I don't know that there's a right answer there. I feel more comfortable with the wire personally.
I feel more comfortable with the wire. For people that are freaked out about it, you're going to want to do a couple things. The very last thing you do before you send the wire, either you're at the bank or you're doing it from your computer yourself, depending on the size of the wire, call the escrow company, verify, is this the correct info? There are scams, there are stories. I know people directly who have sent wires in the six figures to the wrong place and had their money intercepted. It was fixed in those instances, so no one lost money, but close enough that it would pucker you real bad. So by all means, if it's a large amount of money, I wired a $2,000 deposit on that property I'm buying in Orange. I'm pretty damn sure it's not at risk. And if it were, it's not going to kill me. If I were sending them $22,000, I'm going to call before I send that wire.
There you go. We're coming up on the 7 o'clock here. We're going to get a couple questions here so Josh can get his wings. Stasia reviews stuff. Is it a bad sign if a house appraised at right what we paid for it? I wasn't worried about it till I started to hear about other people saying they're appraised higher than what they paid. No, it is not. It is not bad. It is not uncommon. In fact, it's more common than not to have the appraised value come right in at what you're purchasing it for. Real simple. That's the easy answer to the question without getting into everything else. So nothing to worry about there. We got a bunch of pronunciations here. And I can't even, the best part is I can't even sound out the pronunciation of how to say it. That's where I'm at on this whole thing. Anyway.
Yeah, they're giving us like the little phonetic pronunciations. I need to have the thing on Google where I push the button and it says it to me, because otherwise I ain't getting it.
All right, guys, 7 o'clock here. We're going to wrap this thing up right at 2 hours. We're probably going to have another question come in, some donation.
Hey, Jeb, I'm overruling you. We have our favorite Cowboy and our favorite Bronco fans both have questions. So actually, it's not a question.
Right.
Michael, our Cowboy fan, said he sent me the cost sheet for the 232. We'll get our friend Randy Tickle in Texas to take a look at it, make sure there's nothing crazy out of there and it is normal. And then Joey's coming back here. What are typical front end, back end DTI limits used when underwriting? So Fannie Mae, Freddie Mac, there are guidelines, but they generally defer to Desktop Underwriter, the automated underwriting system. Sometimes for very well qualified clients, you can go all the way to a 50%. It's a single ratio. For other borrowers, they're going to be capped at 45%. And for less qualified borrowers, lower credit scores, sketchier situation overall, it may be lower, maybe 40 or 38, but it's a black box. There's no real way for us to know. I just didn't want to leave our two favorite football fans.
And there's another one here. We're just going to throw this one up. You're going to give a really quick answer to this. Jessica Cohen, what should an unaudited P&L look like being self-employed?
Super simple. You're going to start, just list your gross income. This is what we received this year, and then you're going to do all of your expenses. Most likely, if you're Schedule C, just go back and look at your Schedule C and mirror that. Everything, every line item that's there on the Schedule C, and usually on Schedule C, you'll have an item that says see Statement 4, and go to Statement 4, and it's going to have 10 more things that are expenses listed. All of those things that you pay every year that show up on your tax return need to be accounted for of what you've spent on those things year to date. And Jessica, if you have questions, shoot me an email. I can send you a couple of samples and examples. We usually do them with, not for, with our self-employed clients. Say, hey, let's gather the information. What does the income look like? What are the expenses? Are these right? And then we format it up for them.
All right. So we'll add Jeb and Josh's information here if I can find it. There we go. So emails for both Josh and I. If you want to contact him or I, there is the information. If you need a lender, you need a real estate agent anywhere in the country, go there. In fact, there's a link on the little bottom there that is actually ask a couple more questions. It'll get you put in touch with the right person. If you're out there and you need somebody, Josh, any parting words here?
Here's my wisdom. Hustle for your
boy.
passion wants to know what kind of wings. We're going to do Frank's, and we're going to do salt and pepper tonight, and we do all flats, and we do them grilled. Don't fry my wings. That's wrong.
There you go. Josh said it. Thank you guys for joining us. Thanks for all the super chats. I appreciate all the support, all the comments, you guys continuing to be here. It really does mean a lot, not just saying that. So thank you guys, and hit that like button on the way out. Thanks again. Talk soon.